Hi, in this lecture, we're going to talk about bonds. What are they and how do you invest in them? First, what is a bond and what are its associated risks? Now, bonds are debt instruments issued by companies to obtain funding at a lower cost than equity. That means bonds are like loan instruments for companies where they borrow from the public in order to meet their financial needs. Next, to an investor, they offer stable returns compared to equity stock. The coupon rate of the bond determines the interest rate that the bondholder gets as a return. They can be either issued at a discount or a premium depending upon the interest rates prevailing. This means that when the interest rates are rising, bond prices go down, and when in the inverse case, when the interest rates fall, bond prices go up. Why? Because the alternative to investing in bonds could also be investing in savings accounts. So if imagine a scenario where the interest rate in general is going up but the bond rate comparatively is low, so would you still feel like investing in the bond and getting your funds locked for the long term? I don't think so. So that's why there is a direct relation between bond prices and the actual interest rates. Next, there are some things called zero coupon bonds. These are bonds that have no interest rates. Instead, they are offered at a deep discount. Now, you might think, why would anybody buy a bond which does not even offer interests? Well, for that, there's a concept called yield, which we will cover towards the end of this lecture. Now, bondholders stand to lose. Now, these are the risks. Bondholders stand to lose if the general interest rates goes above the coupon rate. Yeah. So now you are locked into a bond, and in the subsequent years, interest rates have gone up. You have relatively lost money because your funds are now stuck at a lower interest rate compared to what the market is otherwise offering. Next, the returns from bonds can often be lower than inflation. So this is inflation risk, as we all know that the prices of anything of items increases on an annual basis based upon the inflation rate. So if the inflation suddenly starts increasing at a high rate, the returns from the bonds may not be sufficient enough to cover up for that increase in inflation. Finally, we have issuer defaults. So these are when we talk about bonds in this lecture, we're talking about corporate bonds. So corporate bonds are issued by corporations or companies, and these companies have an obvious default risk, that is, they might go bankrupt, because when you have issued a loan to them, the requirement for them to pay that might be so difficult that they can end up getting their credit rating changed. So bonds have ratings, and these are issued by credit rating agencies such as Standard and Poor's, Fitch, Moody, etc. And these ratings range between AAA bonds, which are the highest rated bonds, to D, which is defaulter. So whenever you buy a bond, or whenever you plan on buying a bond, you have to make sure that the bond is rated high. Otherwise, you're at a risk. So a lot of these bonds are known as junk bonds, and they might be even offered at high interest rates, but the point is they might not be able to pay back the interest rates. Finally, bonds come with an inherent lesser liquidity problem, as they are infrequently traded. That is, unlike stocks, they are not bought and sold as much on markets. So how do you invest in them? Usually bonds are bought when directly issued by companies, and the way you buy them is the purchase is done through a bond broker or dealer. Now this broker or dealer may be a usual stock broker or stock dealer, or it could also be a separate bond broker specialist. Now, unlike equity stock, the stock of a bond is not determined as a result of demand and supply. Instead, the prices are inversely related to the prevailing interest rates. So we've touched upon that. And again, when interest rates go up, bond prices go down, and vice versa. The secondary market is not an active one, as bond prices, although market driven, are not governed by demand and supply. Now, number seven is buying tends to occur during bearish markets. Any guesses why? So, a bearish market, first of all, is a market where the general stock market is not performing very well. That means stocks are providing poor returns. In fact, a lot of people lose money during this time, especially long-term investors. And what the general tendency is to move towards safety of a stable return, which is offered by bonds, and hence people tend to buy bonds during bearish markets. Now, in terms of returns alone, bonds actually offer good returns over the long term, because it they have, although they come with certain risks, they do offer the benefit of a stable return, which might be very useful for people who wish to take lesser risk from exposures in equities. So a AAA rated bond by a strong corporation might be a better bet than going for an equity issued by the same corporation, which is susceptible to the ups and downs of the market. And this is preferable for people who don't wish to risk losing too much capital. I would say people at the higher age level would probably be benefited by investing in bonds. In terms of asset allocation, they would probably have a high allocation in bonds, and others with higher risk appetite would probably want to invest more in equities. Now, moving on to bond yields. So the yields are important aspects of bonds. The current yield of a bond is the coupon interest divided by the market price of the bond. Yield to maturity is vital to determine whether a bond offers optimal returns. YTM, or yield to maturity, the way it is calculated is, it is the anticipated total return a bond will produce over its life. It represents the internal rate of return, also known as IRR, of the bond. Now, this is important because bonds come with different maturities and coupon rates, so it becomes difficult to compare bonds between each other. So the comparison requires determining the IRR, or the yield to maturity, which requires a complex formula. But if you want to do a YTM calculation, there are a lot of calculators on the internet, and they can help you. Also, this topic might need a bit more research from your end, so feel free to go and do some research on yield to maturity to understand how to compare different bonds. Well, that completes this lecture. If you're watching this on YouTube, do subscribe, and I will catch you in the next lecture. Thanks for watching. Bye for now.